Hello, hello, everyone. Welcome back to another edition of the Weekend Charts. Charlie Bilello here, and with me this week, special guest John Hagensen, Managing Director, Rethink Your Money podcast radio show host. John, great to have you on the show. I've been on your show a bunch of times, but I'd much prefer to be the one asking the tough questions.
Yeah, no, this is great. Thanks for having me. It's nice for me to just be a co-pilot here and let you lead the way, and be on video. You know, I'm normally just a voice behind a microphone, so I even got dressed up for you, Charlie.
Looking good, looking good. People always tell me I have a face for radio, so we should probably switch. I think people are going to respond well to
we
this. What are we going to be talking about
we
today?
got something in common there. I'm told that as well.
I do love radio, so keep that coming. It's just a much more relaxing medium. You can wear whatever you want, and kind of nobody knows, right? So number
Absolutely.
one here, John, don't let them sell you a bond fund. This is a funny one because it's coming from a quote from Bill Gross, right? Who used to be referred to as the bond king. So we're going to dig into that. Number two, saving Social Security. You and I are going to provide a great solution for everyone so we don't run out of money. And there's a lot of options. So we'll run through and debate which one of those options is the best option. But to me, this is something we should do before it becomes a crisis. That doesn't seem likely, but you and I can discuss this. Is the consumer finally pulling back? Right? We've been waiting for this. Inflation keeps coming. Well, is the consumer finally saying this is enough? There's some signs of that, so we can talk about that. Falling fertility rates, buy in May and stay, which is my preferred slogan to the sell in May, and we'll talk about why that should be the slogan investors talk about. Welcome to the casino is a new concept that investors are using single stock ETFs leveraged. So we're going to debate whether that's a good idea. And we're going to end, as we always do, with something positive, and that's the fact that workers are actually pretty happy today, which is kind of unusual, the happiest really they've ever been. So we'll dig into that. All right, awesome. Let's get started. Number one, don't let them sell you a bond fund. That was Bill Gross' tweet a few weeks ago. Latest investment outlook. Yep, I said it. Total return is dead, John. Don't let them sell you a bond fund. You're only clipping coupons. Don't expect capital appreciation. Of course, this got a lot of attention. And what he's essentially arguing here is, of course, he's making a forecast. He's saying in his note, 10-year yield is going to be above 5% in the next 12 months. Not 4%. I don't know how he knows that, but that's going to cause more pain in the bond market. And it's already been pretty painful. This is the longest bear market for bonds in history. It's not even close, 45 months and running, and we're still in around a 13% drawdown. So while stocks have recovered, hit a whole bunch of all-time highs already this year, bonds still in a long drawdown. Before we dig into some of the details in terms of bonds, what do you make of a statement like this? Are bond funds dead? To me, it kind of would have been a good thing to say back in 2020. But today, we're in a much different place. How are you looking at the bond market in terms of talking to clients and this stuff? I know it's a huge issue that people are talking about because we've never been in this situation before.
Yeah, great book, by the way, recently came out. I think it was actually titled The Bond King. I can't recall exactly, but I read it and it was very interesting on Bill Gross's career. So it's always interesting when so-called experts make predictions and forecasts because we think to ourselves, well, they're the expert. Look at all the money that they managed, that like maybe we should listen to them. But of course, you and I both know they don't have any inside information about what's going to happen over the next 2 years, just as all of us don't. So I'd say a couple of different things. It's not a newsflash that capital appreciation isn't the number one priority with bonds. So I think the entire beginning premise is, well, yeah, of course. Like if you're looking for long-term growth over the next 15 years, you're insane to put it in bonds and think that it's going to outperform stocks because that almost never happens. So that would be my first, why are you buying bonds? If you're buying it to buffer your stocks for short-term needs over the next 5 to 7 years, you're not prioritizing capital appreciation. And we saw, the chart that you just showed, when you do try to prioritize or sort of straddle both sides of that fence, you end up cheating out on duration and you get killed when rates go up, like we saw in 2022, or you start buying things of low credit quality, like junk bonds, which also have a very high correlation. I think the last I saw, it might have been something you put out, was like 0.8 to the S&P 500. So you're getting a high level of correlation, which is not what you're looking for in bonds. So that would be my first point, is it's not even the right starting place to look at and evaluate bonds. But you started to hit on something that I think is the more important point. And that is, who cares what bonds did the last 20 or 30 years? What's the outlook for bonds right now in 2024 moving forward? It's really good. You're making great yield. Yes, could rates increase? You and I don't know. No one knows. Bill Gross doesn't know. They could, but we're starting certainly from a higher rate environment to begin with. So it feels like there's less, probably less opportunity for it to dramatically increase again. And all the while, you're creating the stability you want. And in shorter term or even intermediate term bonds, you're making some nice income.
So this is a big debate I always have, though, John. Right? It comes back to bond fund versus individual bonds, right? Or bond funds or buying treasuries and matching that duration, right? Where if you buy that treasury bond and hold it to mature, you're going to get that principal. And most people aren't looking at that, marking it to market, not in the same way you see that loss in terms of a bond fund. So for certain people, do you find that if they're so risk averse that they can't tolerate seeing that drawdown, even though optically, even though it's the same thing, would it be better for those people to simply go out and buy either individual bonds matched to their duration that they have in terms of when they're going to be withdrawing from their portfolio versus being in a bond fund? Is that a legitimate forget about what Bill Gross said. Is that a legitimate debate to have? Because to me, it does make some sense if psychologically you're going to make the wrong decision at the wrong time in terms of seeing a drawdown and then selling.
Bingo. It's all optics. And personal finance is a lot more personal than it is finance. And so if someone's going to have better behavior, and I think the key is doesn't mind creating a little bit more aggravation and complexity within their portfolio. Obviously, the size of the investment matters here. If you want to be diversified in bonds and you've got $4,000, buying individual bonds is pretty tough. If you're going to go out and buy individual bonds with $4 million and you really prefer to see them individually rolling off and maturing and not needing to worry about that interest rate risk, then I think that's totally fine. But let's be real here. A bond fund that's a 5-year duration bond fund, theoretically, every single bond inside of that fund is rolling off over 5 years, right? So yes, the price is going to be fluctuating and they're going to be adding new bonds back into the portfolio. But like if you buy it in 2024 and you hold it until 2029, theoretically, all of your interest rate risk that happened during that time is mitigated. But it is difficult because the optics are, I'm seeing the price fluctuate and there isn't a direct end maturity date on the entire bond fund.
Right. So I think the worst reason to buy a bond fund is actually what he's talking about, which is betting on the direction of interest rates, and specifically,
oh yeah, that's insane. Yeah,
betting on them to go down. Now I may understand that, right? In the early 1980s, we're looking at 20% yields. Okay, someone might be speculating, okay, that's going to come down. But today, where we are today, whether they're going to be percent higher, percent lower, doing it for that reason, terrible reason. Do it for the duration, right? As you said, the average bond fund, if we look at the aggregate in terms of AGG or BND, which is the products most people use, you're looking at around 6 years duration, right? Which means that if the interest rate goes up 1%, you're going to lose 6%. But today, John, and here's the kicker, today you actually have a yield to combat that price decline. Back in 2020, yep, there was nothing. You could see here at 50 basis points on the 10-year, it was all loss, right? If interest rates go up, which they did, which wasn't a hard thing when you're at an all-time low, you took all of that loss. Today, you're almost break even if we go up 1% because you're earning that coupon. And so a much different place, not only just in terms of nominal yields, bumping up close to 5% now, but inflation adjusted yields, we haven't really seen this, right? We've been used to kind of a period where you almost get nothing as compared to expected inflation. And today you're over 2% above it. So in terms of like the last 20 years in bonds, this is pretty much the best we've seen in terms of nominal and real yields. You have to go really back to 2007 to be in a situation that we're in today.
Yeah, I mean, going out on a 30-year bond fund in hopes that rates will drop and you'll get a lot of capital appreciation. I mean, it's just speculation, right? It's just like going out and buying an individual stock or doing something else that's not a long-term disciplined strategy. It's just betting on the movement of rates, which is a big risk because nobody knows. There are a lot of factors that contribute to that. And so, yeah, I don't think that's a great strategy at all. And I just feel the criticism or even debate around bonds right now is mistimed. Like, why are we having it, to your point? I'm looking at this slide. Why are we having it right now? It's actually a pretty good environment for bonds right now, certainly relative to the last couple of decades.
I guess what people were loving bonds in 2020, they were, screaming about deflation and depression, and this is going to be the
True.
hedge
Yeah.
against that, right? And
Yep.
here we are with yields over 400 basis points higher, and they can't stand them. But I always come back to this chart because there's no chart like this in the stock market. Like the predictability of the stock market over the next 7 years, almost impossible to tell you
Mm-hmm.
what the return is going to be. Bonds, very different situation. And it's just math, right? In terms of
It is.
interest rates, the starting rate, there's nothing more important. It dictates everything. So, yeah, when yields were at zero, that was your return expectation. Today, with yields close to 5%, I don't know what's going to happen in the next year. Bonds could be down 5%. They could be up 10%. All dependent on where interest rates move. But over the next 7 years, you're very likely to have a return, let's say, of 4 to 5%. And does
Agreed.
that type of probability that should matter, right? In terms of that end investor, that should kind of be why you would own a fund today.
Absolutely.
So last point in terms of interest rates falling, and of course he's saying it's not going to happen. I don't know what's going to happen. They could go above. I wouldn't surprise me if they went above 5% or below 4%. But in terms of when the Fed has started cutting rates, I would just keep this in mind. And maybe they don't cut this year. People were expecting them to cut 6 to 7 times, and now we're only expecting maybe 1 to 2 times, and maybe that doesn't happen at all. But what we've seen historically, John, every single time the Fed has done a rate cutting cycle, guess what? Bonds actually do pretty well in that
Mm-hmm.
environment, and you can't rule that out, right? That rate cuts, we know they want to cut rates, right? Their biases, just give me the chance, right? Show me that lower inflation rate in terms of cutting rates, but that would be an additional boost. Not the reason you should be investing it, but it's kind of the way I look at it is kind of a hedge in that environment. Let's say the Fed is forced to cut rates for some reason 300 basis points in the next year. Well, to me, that would mean, okay, there's economic weakness, right? Now there's a slowdown,
Sure.
less consumer demand, less inflation, and maybe stocks don't do well in that environment. Well, now you have another reason why bonds might do well. So it's kind of going back to that old reason where bonds actually do well during a recessionary environment because the fear becomes inflation. Is that valid at all today?
No, I think it is. And I think that was the justification a lot of people used when going out in these 30-year, long-term treasury ETFs. They were saying sort of the same thing. Like, if these make a lot of money, it's probably going to be because my equity side of the portfolio isn't doing as well.
Exactly. Okay.
Still
So
very risky though, obviously.
yes, I don't particularly like those long durations. Certainly don't like them when the 30 years below 1%, locking in that in terms of
Absolutely.
expected inflation. That was an absolutely horrible bet. Okay. We'll see if the bond king ends up being right, but I suspect over the next 7 years he's going to be wrong, and you shouldn't be thinking about total return. You should be thinking about coupon. That's your coupon. Know why you own bonds. You own bonds for that coupon payment, for that stability, and for that kind of counterbalance versus what you own in the stock market. Number two, John, this is a big ask here, but we're going to try to save Social Security. Not,
Oh, no, we're
Congress.
just taking care of
Yes,
business here. Yeah.
just a couple of guys here chatting, and we're going to do it. Congress hasn't been able to do it. Senate hasn't been able to do it. No president will talk about it. It's kind of the third rail of politics, right? You can never say you're going to do anything to Social Security. People love getting Social Security. We know that. They would like, I think, therefore, for it to be around, but for some reason we can't prevent this slow motion train wreck from happening. And what I'm talking about here is the fact that today we have the benefits that we're paying out above the income, and that's projected to increase, right? So we have all of these baby boomers retiring, right? We're talking about millions and millions of people collecting those benefits. Yes, they paid in all those years. They deserve to get their benefits. But guess what? We don't have the same younger workers to replace that. So that gap is going to deplete the trust fund here. And the projection is by 2035, today it's above 2.75 trillion, but by 2035, the projection is if we don't do anything else, it's going to run out. So here we go. Here are the different options we have. It's not like this is some kind of secret, right? How to replenish that trust fund. The question is, do we have the political will to do it, and will people go along with it? I think some of these, for sure, everyone will be like, yeah, let's do that. Like if we look talking about lifting the cap on earnings, right? We're talking about like billionaires. Everyone would be happy for them to pay all of their income in terms of Social Security. But the rest of these,
other than the billionaires, though, Charlie.
Other than the billionaire, but so few of those, John, doesn't matter, right? Like the populist wave, I think would overwhelm that. But I don't think that's enough. That's obviously there's not enough money there. I think you're going to have to do some of these others. What do you think in terms of either raising the payroll tax, increasing that retirement age, which seems like that will be necessary? People are living longer. When they started Social Security, they never expected people to live long. No one's going to want a reduction in benefits, right? Even for higher earners, I think that'll be a tough one. Slow the growth rate in benefits in terms of we're adjusting it for inflation. In the last few years, guess what? Inflation's been enormous. Well, that's been an enormous increase in the payout. But so there's your take. And then I'll tell you what my preference would be. And that's this one here, cut spending elsewhere. I'll tell you a few places I think we can do that. Okay.
Well,
what do you
yeah,
think?
I am curious your thoughts. I mean, first off, this would be a very easy problem to solve by cutting spending elsewhere and diverting to Social Security Trust Fund, as you have there listed at the second from the bottom.
Mm-hmm.
But we have $33 trillion in counting of national debt. Like, we have shown absolutely zero intestinal fortitude from a political standpoint to balance the budget. I think we've had 1 year. It was one of the Clinton years where we actually ran without a deficit, right? So
That's
this
right.
is on both sides of the aisle. Politicians want to get reelected, and cutting anything for anyone that votes for them or potentially would vote for them and probably wouldn't if they came out and said they weren't going to, they were going to cut some of their benefits. It's just so unpopular. And but I think that would be the obvious one that most logical people would say, well, yeah, that we could do that. I think the idea of pushing full retirement age back to 70 or which would be really extreme, I understand, but pushing it back at least a couple of years makes a lot of logical sense. I mean, you think about when the New Deal went into effect in the 30s, full retirement age was 65 for Social Security. Life expectancy was 62 and a half, Charlie.
Yeah. Crazy.
So we've moved it from 65 to 67, and we're living 20, 30, 40 years longer in many cases.
They're literally right. Wasn't really a retirement for most people back then.
No,
that concept didn't exist. You worked and then you died, essentially, I guess.
Yeah, well, I mean, the entire premise of it was, hey, this is old age poverty insurance. Like, if you happen to live to 75 and you don't have any support, we want you to have some sort of safety net so that it wasn't a drag on the rest of society and the economy. Like, that was the idea. It wasn't designed for somebody to retire at 62, live to 102, be on the benefit for 40 years getting inflation adjustments. I mean, the demographics simply don't work. There are too many boomers. And for those that don't know, like, it's current workers that are paying for current retirees' benefits, right? And so it does matter how
also
much
known
are
as a Ponzi scheme.
Yeah, basically, right? A legalized Ponzi scheme by the government, exactly. So, you said, I think that from a popular opinion, removing the cap like we have on Medicare for Social Security benefits may make sense. I've seen a donut proposed where it's, hey, it goes up to this cap, and then between that and let's say 400,000, nobody has to pay anything extra. If you're really rolling and you're making more than 400 grand or 500 grand or $1 million or whatever that number is, now we're going to kick back in Social Security and continue to tax that again. So I think that would be an option as well. What do you think, Charlie?
Yeah, my preference always instead of trying to raise taxes it's because I don't think it's because taxes are too low. I think it's because we haven't treated this program responsibly that we're in this situation, right? So corporate America has totally transitioned away from the idea of a pension, right? And that we're not going to have a money set aside for you. We've moved to the 401k model. We've moved to the IRA model as a society. Why isn't the government starting to do that, at least slowly? So any deal that is a result of this, and we're going to do something, but we're probably going to wait to 2035 until, honestly, until we do something, right? Until the threat is there, until people are saying, we're going to cut your benefit if we don't do something. I don't think it'll get done until then. But my personal belief is we have to solve this long-term problem of not having, here's John Hagensen's account. He knows this is the amount of money that's in it. This is what, even if it's only, there's been proposals, right? Should some of it go into the stock market? Okay, let's not even make it controversial. Just put it in a treasury bills and roll it, or treasury bonds. Anything would get a higher, I believe, higher rate of return than what the government is giving you right now for most people. Right. So
Yeah, well, absolutely. I think to your point, it's a good one saying, well, we could increase taxes, but one, what's the ripple effect of that on corporate earnings and, wage increases and all the other incidental, unintended consequences that would occur from that actually happening. I think you're right. And the second thing is, okay, so we have more tax revenue. We don't have a tax revenue issue with our federal government. We have a spending issue. So I agree with you there. You're saying, well, we do that. Does it really solve the root of the problem? And it probably doesn't. I love the idea of privatizing it in some way. In fact, I looked at one proposal that said if the day an American baby was born, they drop $5,000 into an account. Like that was the plan. And let's say it was in a 60-40 and it made 7%. I don't know. I mean, we'd get into all the nuance of that, but I agree with you. I don't think you control. I don't think you allow the participant to be able to control the investment decision. Something would have to be centralized with that so that it was hopefully growing and compounding. But if you ran that until 70 years old, just putting $5,000 in once and in a 60-40, that person would have $600,000 at 70 years old. If it made 8%, they'd have 1.2 million. Right. And so if even you're taking like a 4 or 5% drawdown rate, now they're getting 30, 40, 50, $60,000 a year. Plus they've got a lump sum. I don't know how we would work that. Maybe the excess would flow back in to the program, right? If somebody died early or didn't use all of it or whatever it might be. But to me, that starts making a lot of sense. But that would be a 50-year transition, right, Charlie? I mean, that would be something where they'd start it today. That doesn't solve the immediate problem, but it would help us down the road.
No question, right? You can't, for current retirees, that would just be politically, suicide.
Yeah.
No one's going to propose that.
Right.
But for like people in their 20s who don't usually vote as much, right? Start changing their benefits, start taking a portion of what they're supposed to get, or to me, start doing all of it and putting it into a fund, right? Like, and if we did that, I'd almost be in favor. Okay, you want to raise taxes to do that? Okay, to get that job done. Okay, because at least then you know what you have when you retire, and you stop this game of, and Peter and I have talked about this a number of times, where people have to predict essentially when they're going to die, like in terms of taking Social Security, and they often make a bad decision. They often just take it right away because psychologically they're worried about if they die early, they're going to be leaving all of that money on the table. They shouldn't have to worry about that, right? If the money that's coming out of your paycheck is really for your retirement and it's not just a tail risk thing, then let's make it an actual account. But I could think of a million places I would cut spending before doing anything else and just diverting it, saying we're not going to do another 95 billion like we just passed to send it overseas to this war or that war. We're going to take care of our citizens and the American people first before we start to play all of these games globally. And if you really care about that, well, you should care about people in America first, I think, and make sure that this is a program, if people like, that's going to continue to be here. All right, we could talk about this for another hour.
I just think it's surprising that the Democrats and Republicans don't agree on how to solve Social Security. That's really the real surprising thing to me, Charlie.
I think that they could come to an agreement, John, but I think that it's even saying anything about it, it's not worth the risk until it's an actual crisis. So where's the upside of even if saying something prudent like, oh, we're going to raise the full retirement age to 7? Where's the upside? You're going to lose those voters if you say that, right? It's just
that's going to be thrown in their face for the entire election season if they were to say something like that. Absolutely. This person wants to take away your Social Security.
Yeah, but to me, like cutting spending elsewhere, especially wasteful spending or spending that people would agree, like, yeah, that's crazy. We shouldn't be spending there. That would be something I would think that a lot of people would get behind, saying like, let's take care of Americans first.
So, well, you've talked about this recently, Charlie. What is the federal budget this year? I mean, it's insane. How much are we spending?
$7 trillion.
Yeah, $7 trillion. It's wild.
Yeah. So, and we've increased spending, John, over 5% per year in the last 25 years, which is more than double the rate of inflation every single year. So just to give you an idea, again, it's not a revenue problem, it's a spending problem. And it's like, we think you go back in time and think of what the Boston Tea Party was about, and the rage over that, like, and compare that to the taxes that we all pay today. Like, people should be more up in arms, I think, about that, and not result to that as being a quick fix here. Let's think longer term. Let's fix this program. I think we could do it,
We're the
but we're
we're
not
the
going to
we're
do
the
it
rich
today.
uncle. We're like your rich uncle who makes $4 million a year and is spends 5 million. You're like, what's wrong with you? Like, can you just
Yeah.
keep it within the box here a little bit? Nope.
Just be responsible, right? Be
Yep.
responsible and have an actual account with people's names on it that they could, if they die, they could pass it on to their spouse, they could pass it on to their heirs. Why
I
not?
love
That
that
just
idea.
makes perfect sense. All right. If you're thinking about Social Security, you're worried about whether you're going to get it or not, talk to us, reach out, Creative Planning. I'll have the link in the show notes. You could talk to someone like John, many great wealth advisors here. We're in all 50 states. So set up a call, set up a meeting, over 300 billion assets under management and advisement. Go to creativeplanning.com/Charlie for more information. Again, I'll have a link to that in the show notes. Number three, is the consumer finally pulling back here, John? It seems like every week we hear about, oh, consumer, they're stretched. Inflation's is just taking its toll. We have 36 now consecutive months above 3% in terms of CPI, and we're going to get another report next week. It's going to be above 3% once again. And what we're starting to see here, this is a little bit troubling, is people are starting to lower their savings, I think, to maintain their spending. And we saw this definitely in 2022 when we hit 9% in terms of the inflation rate, but we're starting to see it again today. We're seeing retail sales below historical average. We're seeing inflation adjusted sales almost flat, and they were negative for a bunch of months in a row. And now we have a number of companies in the recent earnings reports, not talking about Google and Amazon and Microsoft. They seem to be doing just fine, but consumer facing companies like Starbucks, KFC, McDonald's, all talking about a potential slowdown here at Starbucks. Actually, revenue down year over year. Very rare to see that outside of a recession. I have another one here, Nike, almost flat year over year growth. And that often is one of the first things people pull back on, is sneaker apparel, even though a lot of people love their sneakers. And then we have Home Depot. I'm showing you here a number of quarters year over year in terms of declines in revenues. Are you hearing anything from people? Because we still have this conflict here where we have, on the one hand, very low unemployment, wage growth is still strong, labor market's still pretty strong. So consumers should still be feeling pretty good. But is it just this compounding effect of inflation, and people that is still front and center for them?
Yeah, I think that's the lag. You hit the nail on the head though. As long as unemployment's low, I think that's where you'll see a significant drop off. And obviously, as consumers, we all have our own personal budgets with our families and where we spend money. And there's certain things that are a much higher priority than fast food might be. Or I'm kind of surprised on the coffee thing with Starbucks because we're also addicted to caffeine. That's usually so. That's usually one of the last ones to go. Uh,
Yeah.
People are like, oh, I'll ride share with a friend to get to work for my commute to save gas before I'll give up my let's still go get our vanilla latte on the way to work together. So
Yeah.
that one surprises me a little bit. But I think as long as wage growth is strong and that's obviously a reflection in part to low unemployment, I don't think you'll see a major drop off. But there's such a lag effect here that it's difficult to know how long it takes for uh, the real data to appear for us. You'd probably have a better idea of that as an economist, but like in terms of like how long we really have to see the impact of inflation.
Yeah, I think that we're kind of on the dividing line here, where if
Mm-hmm.
inflation goes back above 5%, like, that's going to be a problem. Again, if it gets
Mm-hmm.
back above wage growth, we're going to be talking about, a more significant slowdown, I think, than 2022, because 2022 we relied a lot on the reserves that people had saved up
Sure.
during those stimulus programs. If you see here, like, all of these
Yep.
charts, John, it was
Right.
kind of frustrating because they've ruined every chart for me because of because of the stimulus and because of what happened, obviously, during the shutdowns. You can see here people were saving 32%. Yeah, some of it they spent, some of it they traded meme stocks with, but a good portion they saved. And so that
Yep.
built up reserve was very helpful in 2022 when we had that rising prices. Now it's hard to get a read on how much of that is actually left, but now I think obviously there's less than back then. And the big question is, can we hold the line in terms of pricing? But if we look
The
at
treasury totally broke your charts forever, right? You're going to have an
yes,
asterisk next to that every single time and say that doesn't apply, because you're going to have to always
yeah,
say the second highest savings rate in the last 50 years, right? But it's really the highest, practically speaking. No, that's good. I got a pet theory for you. I'm curious your thoughts, Charlie. So,
yeah,
do you think that part of why consumer spending has held strong even in a high inflationary environment, outside of the obvious ones we've already talked about, like low unemployment, is that we purchase things now with such little friction that it's still so easy to buy things? Like, I think about that in my own life. I mean, my kid, I got the wrong pogo stick for our first grader the other day. It was one for 80 pounders. So he was just like jumping on it, but it wasn't moving, you know? So I had to get him a
yeah,
different one. Well, I mean, you literally just, he's on it. He's falling over. He's like, you got me the wrong one. This doesn't work. I'm standing there, and in 4 seconds, I just buy the 40-pound one on Amazon and it shows up. You know what I mean? Like, it's like we
yeah.
don't have to drive anywhere. We don't have, I mean, you can do Instacart if you really want to, if you don't mind spending a little bit more money. Like, everything is so easy to buy that I wonder if that has an impact on why we're continuing to spend, because we don't have to even get in our car and take any effort to go get things.
Yeah, for sure. I think the ease of that. I mean, ultimately, it's a good thing, right? I mean, I don't know
Right.
if we need everything same day, if that's completely
Right.
necessary. But
That's the
I,
best when when you order something for your kids and they go, when's it going to come? I'm like, tomorrow by 10 p.m. It's, 3 in the afternoon. They're like, what? 10 p.m. tomorrow? I'm like, that's barely over 24 hours from right now. Like,
it's so
that's quick, guys.
yeah, it's so ridiculously easy that it's almost
Right.
impossible outside of an employment slowdown to cause it. But I think the big divide today, John, is between uh, travel spending, entertainment spending, and goods spending.
Mm-hmm.
So we
Yep.
saw the huge during COVID, that huge spike in goods spending, right? People were home, they couldn't go anywhere. They spent money on iPhones and iPads and obviously spent money on their home. So Home Depot, we showed that chart there. It's down in revenue, but look at that spike that it had, right? They were
Wow.
buying, look at Nike, right? They were buying these things because they couldn't go anywhere. And then it transitioned to things like Taylor Swift concerts and traveling overseas, right? Which is booming. And even within the US is booming, right? And I think that's still ongoing, right? That spending
Right.
really hasn't let up. And this summer, it's still expected to be strong. But if we look at overall consumer confidence, what they're talking about is elevated price levels, especially for food and gas. That's dominating things. And if you ask people, what are they going to pull back on first? It seems like that's the first category, that food away from home. And I've hit this a lot just in terms of the price increases there. It's crazy over the last
Mm-hmm.
5 years. If you went to Starbucks or you went to McDonald's 5 years ago and you went today, the increase is just way, way above the overall rate of inflation. So I think people are feeling that.
There's a tipping
And
point, right, Charlie? I mean, at some point you go, well, it's a little more, it's a little more, and then at some point you go and with your family and you order, you're going through the Chick-fil-A drive-through or whatever, and you go, wait, what? It's
yeah,
this much? I mean, whatever that number is, it's probably different for everyone, but there is a tipping point.
and I love Chick-fil-A, but I don't, in terms of like McDonald's, I was talking about like these Big Mac meals, like in certain places now, they're $15 to $20, right? Like you're
That's
getting a
wild.
much better burger at home, cooking
God,
it yourself than there. At a
that
certain
had to have
point,
been a New
people are
York
start.
stat. That had to
That's
have been you
definitely a New
guys in
York
New
state.
York.
Yes. I think it was Connecticut, but not far from here. Yes.
Somebody listening in like Lincoln, Nebraska is going, wait, what? $20?
Yeah. A little bit of a difference. So we'll see. People are pulling back a little bit so far. Not there's a lot of noise in this data. I think it's too early to say that this is a big shift. I think the big like consumer sentiment thing though is that direction of inflation. What we learned over the past 2 years, John, is people really, really hate higher prices. And even though their incomes have gone up, they're not viewing that part of the equation. They're just viewing, look, I'm going to the grocery store and this is costing me that much more. They're not saying my income is up 20% over the
I,
past
I
few
think it's
years.
I think it's more that we feel, and I don't know if this is correct, but it seems like we probably feel a little bit more entitled to the pay raises. It's like, oh yeah, well I earned that pay raise, right? And then we kind of just forget about it and absorb it into our lifestyle. But the prices are just front and center in our lives over and over and over. Where the
Yeah.
auto deposit from our wages just drops in, and that's what I get paid.
Yeah. No question. It's like you're not feeling it in the same way. It doesn't have that same response. And
Right.
as we know from studies, right, as soon as you get that bump up in pay, right away your happiness goes up for that day and then it comes right back down to a
Yep.
baseline level. But we're going to talk about that in the last segment here. I want to touch on this pretty quickly. Falling fertility rates, big issue globally, but in the US, John, now we're down to 1.61 births per woman in 2023. That's a record low. Replacement level 2.1. And if we look at where we were in the 1950s and 60s, probably hard for people to believe, but we were well over 3. And so just a huge demographic shift. And you can see here, still more births than deaths, but we're getting closer to the point where that's not going to be the case. And we actually had the fewest births in 2023 since 1979. And we could talk about the different reasons. Again, this is not just a US phenomenon, but I think this chart here explains a lot of this here in terms of this was a poll put out by the Wall Street Journal last year asking people about which values are important to them. And you can
That's
see
great. Wow.
patriotism down, religion down, having children way down, and community involvement down. And what has gone up? Money. And of course, if you're having fewer children, the money situation, as you know, is a lot easier. Now, this is a big question right here, but do you think this trend is going to continue? And what, if anything, can we and should we be doing as a country to kind of counteract this? Obviously, we know not a good thing. China's at like 1 now or less than 1. They're in real trouble. But for the US, is there any hope that we can change it? And should we be trying to do that as a society?
Yeah, well, I mean, I think it's a much deeper rooted problem as that chart. That was a really interesting chart that you showed, and I think I sensed that it quantified sort of how I already feel like people what the narrative is. But you're the economist and I'm the guy with 7 kids, so I don't know if I'm like the the now. In all fairness, 3 biological,
so you're
4
doing your
4
part,
adopted.
saying?
I'm doing my part, but 4 adopted. I guess those don't count for the replacement rate stuff. But yeah, I mean, kids are expensive. They're 250 grand or so per year, or excuse me, from 0 to 18 for a middle income American family. So
Yeah.
I mean, you're talking $250,000 per kid for a middle income family, and that obviously impacts things. I mean, you just look at like things like the divorce rate. Divorce rate in 100 years ago was 15%. Now, first marriage is about 45% of them end in divorce. Second and third marriage is much higher rate. So I think we have just our value system in general as a country has shifted. And it is a little bit more focused on career and money and those sorts of things. And, you've got one pie for your life. It's sitting there, right? I mean, there's only so many slices. And if you are going to prioritize one thing, something else is going to have to give. So I don't see this trend, unfortunately, changing. By the way, I don't think it's bad for, I think it's great that women are career oriented and making more money and contributing. I think a lot of times women are more qualified and smarter than us men for a lot of the jobs. So I think that's fantastic. But there is an impact in terms of, when we seek a lot more families of having both couples working and things like that, it's harder to have, you can't have 7 kids like we do if both spouses are working. It just doesn't really work. And so I think we're going to have to solve it from an economic standpoint, or that chart on Social Security that we showed earlier, Charlie. It's
Yeah.
probably going to look worse and worse, right?
This is right. This is front and center, right, for that chart.
Mm-hmm.
You're just going to have fewer people. We're not seeing the direct. We won't see this for 20 years, right, in terms of what this impact is going to have, right? It's just, especially the way it's currently set up. So more important than ever to get that system in a good place before we get to that point. But I guess incentive wise, you could use the tax code, right? You can use things like that to gentle nudges. I'm not sure. You definitely don't want to go the China route, right? Like where they went to one extreme where they're
Right.
saying you can't have more than 1 kids, and now they're using all sorts of propaganda to try to get women to have more kids. And guess what? They're just not listening. They're not doing it, right? Like so.
Do you think a
I'm
tax credit
conflicted.
is the option, Charlie? I mean, do you think that like it's a good, do you think it's helpful? Because I don't think necessarily if we gave a tax credit to try to motivate someone to have a kid that didn't want to have a kid, like I don't
Not a
think
good
that's
reason.
a good,
Yeah.
that part's not, but maybe if someone who would like to have a kid but says, you know what, I don't know if I can afford to have a third kid or a second kid. I just don't know if that would work for our family construct. So maybe it
Yeah.
is good for that person to say, well, I'd have a little bit more of a safety net and a little bit more in, it wouldn't be quite the financial hit. So I think maybe from that perspective, it could be helpful. What do you think?
I think for sure use it to the extent the gentle nudges and incentives matter, and if there are people on the fence of it, and I'm sure there are because of the money situation, that would be help. It's such a important national interest thing that I would say absolutely we should think about nudging it, but changing like these attitudes, like that's going to have to require a cultural shift. It's not going
What
to be economic. You know,
and
it's
maybe
going to the community thing, I think, is a huge one, right? Where we used to
right.
have, you know, if you go back to like, you know, this is showing since 1998, but if you went back to like the 50s and 60s, you know, a lot of is better today economically, but back then there was much more community involvement. People had their church or their synagogue or their
Yep.
mosque, and that was really a center
Yes.
of community. The kids had friends from there, and you just saw that, and it kind of filtered into the culture, right? It was just
Yeah. Well, and
the
I have
emphasis was, and people would, by the way, people would share bedrooms back then. It was like houses were much smaller, and they
yes.
were like the crazy thing is we had way more kids and we had smaller place, but that was just the culture back then. And today, like people would say, I can't have a kid because I don't have another bedroom to put them in.
Yeah, and like one car for the whole family. I know one other thought that I had while you were saying that is, I wonder too, because I think we've made a lot of headway from this perspective. But like my brother-in-law's from New Zealand, he's a Kiwi, and like so their benefits in a country, obviously a much smaller country than America of like 5 million people. But maybe we could continue to make more advancements for women in the workplace, so that if they did want to have more children, they didn't feel like they were going to have such a give up from a career standpoint, right? Like that might also help too, to say like I can be career oriented and
Yeah.
still have advancement opportunities and get a longer maternity leave, like just as a standard thing, I get a longer maternity leave. Maybe that would help as well, so that they didn't feel like it was like one or the other, but they could really enjoy their career and be a mom.
100%. And we've done a lot of that. I think if you look
Mm-hmm.
at the
I think
changes
so
in the
too.
last 10, 20 years, look at creative planning, right? Like what we're doing, 100%, you can have a
Yes.
family and still have a job.
Yep.
But I think the other issue we didn't touch on is just women are having children later, right? And people are getting married later. There's fewer marriages to begin with, but like everything's been delayed and pushed back.
Sure.
The benefits you said, women are now in the workforce, they have more choice over their careers and things. But if you talk about where we were in the 1960s and 70s of the average age of women having children versus today, like the math is, you know, is way skewed to an older age. And it's, of course, the older you get, the harder it is to have children, and that's an additional, right,
You're
issue and
total
factor.
excuse me. Yeah, you're totally right. My wife and I just had a conversation a while back about, do we want another kid? I mean, we already have seven, right? But we were like, felt like we were done. We kind of were like, wow, we've never been in a season where we're not going to have another baby. And my wife said that exact thing. She's like, nope, not anymore. Like kind of tempted, but I'm too old. Like that was her line. You know, she's just like, not, you know, if I were younger, maybe, but not
Yeah.
anymore. So I think that's a big factor as well. You're right.
Well, send her this video. Tell her, you know, that'll encourage her.
I'm gonna
Okay.
I'm gonna ask her values and to see where she charts
Yes.
those. Right? Yeah. How
Good.
important is money to you? That'll be great.
This is too big of an issue for us to solve here. I think we did a better job with Social Security, but it was a tough ask. A few more I just want to get through here. Buy in May and stay is my saying, John. This nonsense every year. I don't like it, the media is the financial media is obsessed with things like this. But
Yeah,
have you ever had a client actually ask you or say like, should we get out for
I
this
have.
period of time? Oh, you have.
I
Okay.
yeah,
So
yeah,
this is
but
not
it's not often, and it's just because they heard it
okay.
on CNBC, you know, or something like
Yeah.
that, and they were like, "Oh, is this legit?" And what I always come back to is exactly what you're showing right here. It's a positive return. Like it would make sense if there were one specific period of the calendar where consistently and predictably it lost you money, but it's like it grows, and you're showing charts that actually, you know, indicate that it's not a whole lot different. But even if it were a little different, but you still made 2% during that time period instead of 6 or something in an extreme example, you would still want to be invested to get the growth of the 2%. Like that's the part to me that makes no sense.
Yeah, like what are you doing with your money during that period of time that's going to do better
Right.
than 6.4% annualized? And then how about the other question like, okay, this has been the case in the past, but you can't rely on that persisting in the future. Maybe this was just a weird anomaly that is going to be either arbitraged away or just a weird
You've done a
thing
bunch
that
of research
happened.
on that.
Yeah.
Remember, like where you showed that there were a few critical events at you know one period of time that
Yes.
distorted the 1 month returns over the last
Correct.
60 years, and it's like none of
Yeah.
that is relevant. A terrorist attack happened on 9/11, so is September a terrible time to invest? Like, of course not. You
Yeah.
know, it's
During the
just
Great
yeah,
Depression, yeah, May through October was not very good, and that
yep,
drags down the returns. But
Right.
many years, if we look at 2009, right, or 2013, I can think of so many years where if you didn't miss that period of time, you're missing out on 20+%
Right.
returns. And this is, the over, if we want to play the odds are almost indistinguishable in terms of your odds of
Yeah.
a percentage of positive returns, 72% versus 72.9%. You're likely to be positive. And what I always tell people, forget about that 6 month, like, especially if you're in a taxable account, you want to pay all the taxes,
That's the
even
other
if you think the
component.
market,
Like,
yeah,
it's
like
crazy.
like you're betting that on that 6 month period, you're going to pay all this capital gains tax, or, and then you're going to have to come back in, and most likely you're going to come back in at a higher level. Not a very smart thing. And if we look at just any random month, John, to invest, and you look at most investors, they have a 20, 30-year horizon. I'm showing you here the average annualized returns. They're almost indistinguishable. So it doesn't
Yeah.
matter. Any month is a good month to invest if you're a long-term investor. If you're betting on the next month, well, it's a crapshoot. Welcome to the casino. And investing is not supposed to be a casino. And if you're a long-term investor, it's not. Like, odds are in your favor. We know no 20-year period in history where the U.S. stock market has been down. But every year, John, we have these new products that come out, and whenever there's demand, like, Wall Street's very happy to come up with that product to meet that demand, and it's almost always at the end of a big run. And
Oh
now
yeah.
the latest craze here, this is hilarious, single stock ETFs. Right? So these are leverage products taking a single stock like Nvidia and using 2x leverage, so you get double the return on the upside. But of course, if it goes down, and it eventually will have a drawdown, of a sizable drawdown, you're going to lose big. And you see the assets in here just exploding higher this year. Why are they exploding higher? Mostly because of the Nvidia craze, the 2x Nvidia ETF being the largest, almost 2 billion in assets just in that one ETF. And you can see here over the last year, this is why there's demand. You got 418% return for this 2x Nvidia versus just if you invested in Nvidia by itself. Is there any reason for an individual investor to be thinking about playing these games in terms of trying to trade these or include these in your portfolio? Can you think of any logical reason that this isn't going to end probably not very good for these investors?
No, it's going to end terribly for all of them. I mean, you could do this right alongside your FanDuel account, while you're gambling on the over under on the Knicks game. I mean, this is not investing. This is speculating. And the problem with speculating, especially when you're utilizing leverage, is that if you're wrong once while doing this over 30 years, it's over. Like, you could execute this effectively for 10 straight years, go around, puffing your chest, going, I'm the greatest investor of all time. Like, look at how much I've made. And then at one point it goes wrong. And it's like, oh, yep, I'm broke. I lost everything. And think about it, with especially with a high flying tech stock that's seen the growth. I mean, nobody knows the future of Nvidia, but like, you're going to have to be out of this fund when it does have a 50 or 60% correction at some point. You're going to have to somehow get out of it before that, or you're done. You've
You're
lost
not
it.
going to be able to stick with a 90% drawdown, which
Right.
if Nvidia, regular Nvidia is down 50%, which that just happened a
Right.
few years ago, they didn't have
That's what
this
I mean.
product yet,
Yeah.
right? You're going to be, oh, who's going to stick with that, right? Where
Right.
you're looking at the stock that's just, it's kind of crazy to me because you have a stock that's up 20,000% in the last, 20
Charlie,
years.
I want
That's
40,000%.
that's
That's not good
that's
enough.
my point is that's not enough. We need to lever that up. Like, this is one of the most volatile stocks that we've ever seen. But I guess, as Munger said, as long as there's demand for these things, Wall Street will continue to sell to
Yep.
them. But just stay away from it. Or if you're going to do it, like you said, do it with like $1 in money. Treat it like a lottery ticket.
Yep.
Don't put any real money in things like this. Okay, I want to end something positive, John. We always do. Happy workers. This might surprise a lot of people. Hopefully not. Hopefully you're one of these workers. This is a poll Conference Board does every year. 1,700 adults they're interviewing, and actually the percentage of workers, this goes back to 87, they've been doing
Mm.
this poll, hit 63% of workers this time are satisfied. That was the highest in the survey's history. Now, you tell me, John, does that sound about right to you? I know you manage a lot of people there. Oh, the workers for you, this would probably be 100% of the people that work for you,
Oh,
but
because I'm such a nice manager. Yeah, exactly.
but
You know,
does this surprise you at all?
No, it really doesn't, because it comes down to supply and demand. Like, we're in a low unemployment environment, excuse me. And I think what would be interesting is actually to overlap a chart like this at some point with the unemployment rate, and to, to see that, because, if you have options in life, like, oh, my boss is terrible. Maybe they don't like me, right? Let's go back to the example of me. They're like, I don't like John. I don't like work. Like, they've got 20 other options that would probably pay them similar or even a little bit of an increase, because they're switching jobs. Well, that's very different than going, I need to keep this job at all cost, or I'm going to have, I can't support my family. You're willing to put up with a lot more. And I think that, combined with the changes in the workplace from a remote work standpoint as a result of COVID, has, I think, improved quality of life for so many workers who now go get an Airbnb in California for 2 weeks and 1 week's vacation, and the second week their family stays there, but they're out of the snow in the Midwest for a week, and they're working remotely. Like that, for many people, that was not an option in 2019, and in 2024 it now is, which is of course going to improve our quality of life and our satisfaction at work.
Well, you hit the nail on the head. Maybe you read the study, but that was the number one factor for most
Mm.
people why they're so satisfied, is that flexibility, that
Yep,
increased
that doesn't
flexibility.
surprise me.
They could take their kids to school in the morning. They still get the work done, but they could get it done when they want to, and they could do it in a location where they're most productive. They
Sure.
have that choice. Like, they have more ownership over that, which goes a long way. Now, why is a happy worker important? This should be self-evident, but a number of studies showing happier workers are more productive. They work
Sure.
harder, they do better. So it's pretty important. And here's we'll end with this here, John. You tell me your thoughts on this study. The number one most important thing for workers, as we talked about, flexibility, very important, but this was an interesting one here. This Arthur Brooks, he's saying the most important thing you can offer a worker is the sense of accomplishment and creating value in their lives with their work life. So seeing that your work actually matters and you're being noticed is more important even than pay and benefits. Yes, all of those things matter, but this is actually the number one thing. So anyone that could really make this a focus, if you're managing people, this seems to be number one. Does this resonate with you in terms
Oh,
of?
absolutely. Absolutely. I mean, I think they used to torture people thousands of years ago by making them pick up bricks and move them around. And then right when they finished, go, all right, pick them up and put them back over there, right? Because there was absolutely
Yeah.
no purpose in it. So yeah, I think anytime we can connect what we're doing, which is tens of thousands of hours of our lives, like, we want to feel like it's making some sort of difference, rather than going, well, I just do this, it's meaningless, but I get a paycheck. Like, people aren't going to be happy doing that. So I think that's a great, like, at a place like Creative Planning, where we have such a fantastic president and CEO that does a great job from the top down, saying, here's the vision, here's how we're helping people, we're all a part of this. And I think everybody has a lot of clarity on how they're helping people, and more than just earning a paycheck. And I think that's absolutely critical.
Yeah, just being recognized and valued. You're right. Peter does those great updates where he's, shout out to the tax team, shout out to this team, just saying, like, this
Yeah,
matters.
personal examples of, like, hey, this client had this happen and this is how we were able to help them and it changed their life. That lets everybody go, whoa, that was a real person that we were helping and that made a difference. Okay, I'm
Yeah.
fired up. I'm motivated right now.
Yeah, and I think it's just that constant reminder of that, where it's not just that once a year, right? You have this
Mhm.
review and, okay, yeah, you're doing a great job. Like, you're getting that feedback more important. I know the millennials generation and younger generations, they crave that. They want that. I don't think that's a bad thing, to know
Yeah.
where you stand, good or bad.
Don't pick on us
how you're
millennials.
having- Yeah, I'm right on the cusp. I'm not. I just missed the millennium, but
You Gen Xer.
yeah, exactly. All right, John, I know we got a hard stop here, so I think we covered a lot of interesting topics. It was great having you on. We'll definitely do it again in the future. Everyone, if you're watching this on YouTube, you want more content just like it, best way to do that, hit that subscribe button. Check out John on Rethink Your Money podcast. I'm going to have a link in there to the show notes. He does that great job on there every week. And we'll see you next time on the Weekend Charts. Have a great weekend.